Hey guys, Scott here. This is the time of year when I sit down, look forward, and try to work out where the property market is actually heading. So I can come on here, break it down properly, and help people make smarter moves to get ahead in your property investment journey. So over the past couple of weeks, I've been deep in the data. I've been working through it with our data team and my co-founder, who's a data scientist by background, and we've been asking one simple question. Where is the market actually headed in 2026? Not based on opinions, not based on what people hope happens, just based on the numbers in front of us right now. Now, the research team here have been analyzing supply data down to a suburb level, the only group in the country that do this, tracking migration and demand patterns, again at a suburb level, and running different interest rate scenarios to understand what actually moves the market. And here's the key thing that I want to share. If the data changes in 6 or 8 months, the view changes with it. That's how this works. But today, I'm going to walk you through what the data is pointing to for 2026, what really matters and what doesn't. We're going to talk rates, migration, supply, prices, cities, and where the growth is most likely to show up. Of course, I'm not going to break down at a suburb level, but if you really want to invest like a professional, you do need suburb level data. That's critical. And quick one before we get into it, I put these videos out regularly, every single day, breaking down what's really happening in the property and the economy. So hit subscribe so you never miss one of my daily videos. All right, let's get into it. So let's start with the thing everyone is still obsessing over, interest rates. 3 months ago, the outlook was one thing. Today, it's something else. Some banks are talking about cuts. Others are talking about hikes. It's easy to become confused. And honestly, people are giving far too much weight to a 25 basis point move. Inflation is volatile because of factors that go well beyond housing. Energy, global supply chains, government spending, geopolitics. That's why rate expectations keep shifting, keep moving around. Even the RBA has been extremely clear. Decisions are made quarter by quarter based on the data that is emerging. Yes, rates still matter, but they are no longer the deciding factor for housing. When supply is this tight and demand is this strong, a small rate move does not suddenly make housing affordable, and it doesn't crash the market either. Even if rates move slightly higher, that alone won't stop prices where fundamentals are strong. So the story for 2026 is not interest rates. Make sure that you're not distracted. The next big piece is migration. Now I'm talking about migration, people coming from overseas, but also interstate migration and inter-suburb migration is incredibly important. Now, net overseas migration is not collapsing in 2026, but it's also not staying at post-COVID extremes. The data points to net migration sitting around 300,000 per year. That's lower than the surge we saw in 2022 to 2024, but still very high by historical standards. The government is tightening the mix. They're adjusting temporary visas, they're being more selective, but they are not cutting migration. The labor market still needs people, population growth still supports the economy, and housing demand remains very much alive. Now, this next part is the part most people still underestimate. Now, this is housing supply, pretty much the biggest story for 2026. Now, approvals will remain volatile, some months up, some months down, but approvals don't solve shortages. They're just paperwork. What matters is housing completions. What gets approved today takes 1, 2, 3, sometimes longer to become an actually fully built home that people can live in. And right now, completions are running well below what the country needs. There is no credible pathway to closing the housing gap in 2026. Multiple forecasts now suggest Australia could face a shortfall of at least 300,000 accumulated homes between 2025 and 2029. That means the government is likely to miss its national targets again next year. Not only do we fail to fix the existing shortage, but the gap actually grows. So you end up with low supply, low listings, weak construction, and strong population growth all happening at the same time. That combination keeps pressure on prices. So next, let's break down city by city. Sydney becomes a clear 2-speed market. The most expensive parts will slow because affordability is at its peak, but demand will not disappear, it moves. It spills into Western Sydney, the northwest and southwest corridors, and fringe areas where buyers can still get into a home under roughly 1 to 1.5 million. As strange as that sounds, that's now considered affordable in Sydney. Melbourne continues to regain momentum. It remains the most undervalued city among the big capitals, and for my personal portfolio, it's a key area where I am focusing. Affordability is better than Sydney, population growth is strong, And historically, Melbourne doesn't stay discounted for long. Perth remains one of the strongest markets in the country. Despite the noise about Perth being done, the data doesn't support that. Demand is still strong, supply is extremely tight, and listings remain low because people are holding onto their homes, worried they won't find another place to move into. That means fewer properties coming to the market, more competition, and more pressure on prices. That combination points to continued growth in Perth. Now let's take a look at Brisbane. Let's start with inner Brisbane and premium pockets. They will cool a bit simply because they've already run really hard. But growth doesn't disappear. Again, it's going to shift. More affordable, well-connected fringe markets with good infrastructure will do the heavy lifting in 2026, very similar to what we're seeing in Sydney. Now let's take a look at where the growth is going to come from. This is where buyer behavior really changes. Now, affordability is forcing people to compromise. If buyers want space, they're moving further out, often 30, 40, 50 kilometers from CBDs into well-connected outer suburbs, or they're even changing states or changing regions. If they want location, they're buying smaller and choosing units over houses. We saw this clearly in 2025 and it accelerates into 2026. The strongest growth is likely to be in the well-developed outer suburbs for those seeking space. Now, for those seeking proximity, I'm talking about areas with existing transport, schools, hospitals, employment hubs in CBDs and lifestyle locations. You got to look out for the key apartments that are likely to outperform houses simply because detached homes are out of reach for most buyers. Now, we are going to see a collision between first home buyers and investors. This is one of the biggest forces in 2026. First home buyer schemes still matter this year. They're pulling demand from future years into 2026, particularly at the affordable end of the market. First home buyers are targeting areas under the price caps under those schemes, either buying units closer to CBDs or houses further out. At the same time, mum and dad investors sitting on equity are entering those same markets, often with long-term plans to help their kids later. That creates direct competition. This forces prices up, okay? So as a result, many areas currently under scheme caps are likely to see double-digit growth in 2026. Keep your eye on these particular locations. Once that happens, buyers simply shift to the next affordable area. So there will be a ripple effect, suburb to suburb to suburb, as each suburb becomes unaffordable and then buyers move on to the next suburb. Now, I've seen this in the market over the last 20 years. After every boom, crash calls get louder. The argument is always the same. Prices are too high. Debt is rising. Something has to give. I remember people saying that when the median house price in Sydney hit $1 million in 2017. And look at it today, we're near on $2 million. But I want to share with you what's different this time. Debt growth is tightly regulated. APRA hasn't disappeared. Lending standards remain strict. Borrowers are stress tested at higher rates, and risky lending is actively monitored. Yes, people are stretching, but they're stretching into serviceable, conservative debt. That makes the system more stable, not more fragile. So if you're waiting for a crash purely because debt levels are rising, the data doesn't support that view. So if I had to sum this up simply, the market keeps moving in 2026, but it rewards affordability, infrastructure, and basic fundamentals. Prices don't collapse. Growth continues, just in different parts of the market. And if you don't want to take my word for it, don't. SQM, Westpac, AMP, Domain, ANZ, different models, same direction. SQM in particular runs multiple scenarios, and in most of them, national prices grow 8 to 10%, even after accounting for expensive markets flattening out, which tells you exactly what's likely to happen and where demand is strongest. So if you're a first-time buyer waiting for the perfect moment, it's likely to cost you more than it saves you. If you're an investor, the affordable end of the market is where the action is. I cannot wait to come back next year and check these predictions against what actually really happened. Now, if you found this useful, make sure you subscribe and hit the bell so you don't miss the next breakdown. This is your daily property update, 5 to 7 minutes every day, breaking down what's really happening so you can stay a property insider. See you guys at the next video.